Our first set of good news is that the Bank of Canada cut rates and they are signaling there are more cuts to come. However, I'm going to go out on a limb right now and say that the next 3 consecutive months or the next 90 days, we're going to have price declines across the GTA. And I'm saying this with about 99% certainty. Obviously, I'm cheating a little bit. This is based on seasonal trend. We are entering the slow months. However, there are a few troubling metrics that are developing throughout the GTA. The spring market ended prematurely in early May for most of the GTA, and that is being reflected in prices. We're also seeing an inventory buildup of existing inventory and a lot less transactions going through. Now, as always, the GTA market does not quote unquote crash, so we're not going to see anything absolutely crazy. However, we are going to see price pressure across the GTA, and as we have this inventory buildup, it's going to be interesting to see how prices are going to maintain and if we're going to have the same price resiliency that we saw last year when sellers were holding out and not selling and then relisting in 2024. Let's get into it. Now, last month when we looked at the seasonal price changes, comparing what's happening here in 2024 with this dotted bold line versus the seasonal norm, which is the thin black line. Last month, I had mentioned that we're most likely looking at a flat May, and that was based on what I was seeing on the ground floor in terms of deal flow and how things were changing and how buyer sentiment was changing. So I'll give you a quick anecdote just so that you understand how quickly things were progressing. In April, I sold the property for, let's call it 2.3 million. And on the same street, exact same homes, there were 3 more people that wanted to sell their home. The home we sold for 2.3 million, we had 5 offers. And from the 5 offers, there were 4 buyers that obviously didn't get the house, but they were still actively looking on this specific street. From those 4 buyers, I stayed in contact with them because I had these 2 potential sellers that were motivated and they wanted to move quick. One of them more motivated than the other, and they were looking to potentially list in May. Now, what happened is they weren't ready in early May, but they did want to get about 2.3 or the similar amount that I got for the house or the neighbor next door. With every single week that was passing and as we were getting into May, that 2.3 was no longer on the table. That 2.3 was looking closer to 2.2 rather than 2.3. And as we got into June, where we are now, that 2.2 is even off the table. Although we set a comp at 2.3 just right now in April, that amount is no longer available simply because there's just way more inventory on the market right now and there's more optionality for buyers. So from the existing 4 buyers that I had that I could have brought at 2.2 had we acted quickly, most of them are now weighing their options with a lot more options out there in the market right now. So that is what I was seeing right here in May, and that is why when I made that video, I thought to myself it's going to be a flat May. I looked at the stats right now and I thought to myself, well, this is odd. We'll have this price increase. What happened here? Because that is not what I'm seeing. I have an explanation. This is going to make a lot more sense once we break this down into regional areas of the GTA. So as we dive deeper into the median price on a per region basis, here's what we're finding. So this far right column is April's median price, and the one right here, this will be May. So what I noticed is, okay, well, the median price went up from 960 to 970. Call it relatively flat, but it did go up a little bit. However, in York region, as an example, I saw things being flat or in fact sometimes going down. So let's go to York region. So call it quote unquote gut feel. From April, we were at 1.245 and for May, we were 1.245, meaning we were flat. And this is a month prices should be increasing seasonally, but they're not. Same thing for Durham region. We saw a bit of an increase, like 0.5% increase, 5,000 here. Now looking at the city of Toronto, this is where the biggest gain was. We went from 867 to 884, which is roughly 2% increase. And then Peel region flat, and then Halton region flat. So ultimately, the city of Toronto, specifically Toronto Central and Toronto East, is what drove median prices up. And because the dollar volume for Toronto is so big, it skewed the entire median price for pretty much all of the GTA. It skewed it up. Most of GTA was flat. Toronto East and Toronto Central were the ones that were outperforming. Still a ton of demand there, but they skewed the numbers. And this is why now you see, looking at GTA overall, you got to be careful because you're not always telling the entire story. So for the most part, GTA is already flatlining in the month of May when we should actually be seeing at least 1% or more increases. So if we're flatlining now, we're absolutely going to have price decreases going into the summer when everything starts slowing down. Since the beginning of COVID, as a seller, we've been spoiled because there usually has been a lack of inventory for the last few years. And that is pretty much over now. As you can see in the red line right here, the dotted line shows us new listings on a monthly basis relative to seasonal norms. So as you can see in 2024, new listings coming on the market are pretty much in line with where we should be, and this is based on 16 years of seasonal data. So here's where we are. We had 18,612 new listings, and that is what we usually get in the month of May. The elephant in the room is right here, which is the green line, and this is the biggest issue that's causing what is happening right now in the buildup of inventory. So typically, for the month of May, if you have 18,000 new listings, of the 18,000, you'll have 10,000 sales in a regular May, based on seasonal data of 16 years. How many sales did we have? We had 7,000 sales. So this is a material departure from where we should be. So we had 30% less sales that happened in the month of May, which is supposed to be one of the busiest months in any year. So what does that mean for us? Well, you guessed it. That means more active inventory and more homes going unsold. And the buildup of inventory usually means one thing: more price pressure for sellers as things are not moving. The lack of buyers or the lack of transactions happening has not been reflected in prices up until this point, is because we always were operating with below average new listings and below average active listings. So we always had an artificially low amount of inventory. So despite the fact that we had less buyers out there, the prices weren't impacted as much because there was just less inventory to go around. So things kind of balanced themselves out. But now the issue is becoming real because inventory is at seasonal norms and it's actually growing beyond that. However, buyers are not coming back. In fact, to be losing or to be operating at 30% deficit of buyers in what is supposed to be the hottest part of the year is something to be concerned about, especially as a seller. And if you're wondering what the lack of buyers means for inventory, well, here you are seeing it playing out right in front of your eyes. Active inventory right now, or active listings, has gone up above seasonal norms for the first time in many years. In fact, we have 21,760 active listings at the end of May, and that is the highest number we've had in 11 years. So the last time the number was this high was in 2013, and the year before that was in 2010, as we were coming out of the 2009-2008 financial crisis. What does this mean though? As we're growing at this point and we're entering the slower time of the year, if sellers don't have the staying power, this is only going to continue growing and it's going to exacerbate the problem of price pressure. What will be interesting to see is whether or not sellers have staying power. So in the past, when we've gone over seasonal active listings, generally if it lasts less than 6 months, the impact is not really felt. However, if it goes beyond 6 months, that's when things get a little bit more interesting. Obviously, at this point, I'm not going to hypothesize, I'm not going to guess in terms of what's going to happen, but for sure, I do believe there's going to be immense price pressure over the next 90 days. However, I do want to go back and address the interest rate cut that just happened and why I don't think it's going to have any sort of material impact on the market as well as sentiment. I want to bring to your attention the historical discounted 5-year mortgage rate so that you understand how this 25 basis point decrease right now in June is likely irrelevant because of what's happened with mortgages at the banks, which is what matters for purchasing power over the last 7 to 8 to 9 months. Now, I've mentioned this before. One of my mortgages was up for renewal last September. I renewed with TD Bank 5.99. It was a 3-year fixed, September of 2023. That exact same mortgage right now, I had a client get the exact same thing with TD and it was 5.19 for a 3-year fixed, meaning that that exact same product has reduced, the premium has reduced by about 80 basis points in the last 8 to 10 months. Purchasing power has already been brought back by the banks by them reducing the risk premium that's baked into their mortgage products. So right now, the exact same mortgage that I had from last year is much cheaper. And that's because of the erosion of the risk premium. So the banks feel there's going to be no more rate hikes. They probably feel the market's more stable now and potentially going to have more rate cuts. So the banks are getting more competitive and offering lower products. So the purchasing power has actually increased. So this 25 basis points decrease pales in comparison to the 80 basis points that we've already dropped based on the risk premium at the banks dropping, which is what actually has increased purchasing power over the last 8 months. And although purchasing power has been increased over the last 8 months, we have had a below seasonal performance in terms of the market. Less properties are selling, prices haven't gone up as much as they should for the seasonal norms that we do expect for the spring market. The spring market did end prematurely. So what is the 25 basis points going to do now when we just had 80 basis point reduction given to us and it didn't do that much? So ultimately, I don't believe the 25 basis points is going to do much, but that is obviously just my opinion. And that is why I don't think it's anything to be excited about. Now, if we do have more consecutive cuts in the coming months, then that's a different story altogether. So we definitely have an interesting market ahead of us, and I look forward to reviewing what happens in the next few months. Don't hold your breath. I do expect more active inventory. Transactions are probably going to come to a standing still, and we're going to have a repeat of what I believe we saw last October and September, where we had some of the lowest deal flow in the last 20 years. And I think more of that is probably on the table for the rest of the summer. Hopefully I'm wrong. Let's see, and I'll see you in the next one.